Folks, 3 violent things to discuss today. Number 1, a big report that is coming tomorrow. Number 2, the latest warning from the big money elites who have been eluding super hard. And lastly, number 3, squeeze plays to talk about, including the latest on Triple BY and Party. Both plays have now run over 100%, briefing price to highs. What do you need to know about them and what's going to happen moving forward? And today's video is brought to you by the ravishing buttons down below. You know what they say, the best prescription is a subscription, so make sure to subscribe today and hit that ravishing like button. So tomorrow at 8:30 a.m. Eastern, we are getting the next CPI release. What did we have at the last report? Well, we had year-over-year all-item inflation coming in at 7.1%, the monthly change coming in at 0.1%. Core went up 6% year-over-year and 0.2% month-over-month. So what are the expectations this time around? Well, expectations are to reaffirm the dipping trend line from November and get 6.7% annual all-item inflation. And expectations are to see core go down to 5.6% annually. And markets are expecting to see a pretty clear, consistent downtrending line for a while, thanks to dropping material costs and supply chain healing. But a lot of people do oftentimes forget the other cost, labor, and the concept of the wage price spiral. Employers have had to pay more and more to employees as a result of all these previous cost of living increases, and those wages are a lot stickier in that employers seldom give workers a pay cut. They usually just keep paying them the same or fire them. So that higher labor cost gets fixed into the prices and you get permanent inflationary pressure from that, right? Meanwhile, Bloomberg reported this morning that the cost of living crisis is still the top immediate risk for the Davos elite. One thing I love about the elite is that they are always so kind to take time out of their very important days to warn us in the peasantry about problems. And I always like to say, hey, you should probably trust the elites before you even trust yourself, because they're just looking out for your best interest, right? But in all seriousness, here's what they said when asked which of the following best characterizes your outlook for the world over the short term, 2 years, and long term, 10 years. Here's what the answers look like. Almost 7 in 10 respondents reckon the near term will be characterized by volatile economies and multiple shocks, while a fifth of them fear catastrophic outcomes within a decade. For 2 years, the biggest expectation is for constant volatility across economies and industries with multiple shocks, accentuating divergent trajectories. And in 10 years, that still is the winner, although it consolidates a bit and you get more in the slightly volatile and or progressive tipping point categories. But these elites see the most immediate risk as the cost of living crisis, a crisis that a lot of people think is behind us when in fact, I got to agree with the elites here. The cost of living crisis is going to continue to be a massive, massive problem in the coming years because a lot of prices aren't going to go down. They're just going to slow down. But at the same time, a lot of people are going to be losing their jobs. A lot of people are going to have more and more economic uncertainty. The cost to borrow money is significantly higher than it's been in many, many decades, so on and so forth. And according to some big firms, markets are underestimating inflation once again. Quote, some of the world's largest asset managers, such as BlackRock, Fidelity Investments, and Carmignac, are warning markets are underestimating both inflation and the ultimate peak of U.S. rates. Just like a year ago, the stakes are immense after Wall Street almost unanimously underestimated inflation's trajectory. Global stocks saw $18 trillion wiped out, while the U.S. Treasury market suffered its worst year in history. And yet, going by inflation swaps, expectations are again that inflation will be relatively tame and drop toward the Fed's 2% target within a year, while money markets are betting the central bank will start cutting rates again. And this is a complete opposite of what the Fed is saying, at least in terms of cutting rates. The Fed is saying we're going to keep rates elevated throughout 2023 and into 2024. Markets think, hey, inflation is going to plummet fast, but so is the overall economy. And as a result, the Fed's going to have to U-turn before 2024 even happens. Now, according to an asset manager from Carmignac, the biggest mistake markets are making right now is expecting inflation to come down to 2.5% next year, when we actually may be in a cycle similar to what we saw in the late 60s to early 80s. In that period, energy shocks drove U.S. inflation into double digits twice. You had 3 big whoops upward in the CPI that each time afterwards had huge plummeting periods where it seemed as though inflation had steadied out, but nope, it hadn't. So they are suggesting here that, hey, perhaps we see inflation die down for a bit, but it does not guarantee at all that we are going to avoid another further round back upward. If the Fed takes the foot off the brakes too early, we could see another massive inflationary spiral, right? And Powell came out yesterday and said, hey, the Fed may have to make some very unpopular decisions to stabilize prices. I think at this point, the Fed is already about as popular as a recreational colonoscopy. Who would want a recreational colonoscopy, Charlie? Exactly. I rest my case. He said, quote, price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term as we raise interest rates to slow the economy. He also stressed the need to keep politics out of central bank policy. This gives flashbacks to Trump famously criticizing Powell for raising rates back in the first hiking cycle, and Senator Elizabeth Warren in this cycle also criticizing Powell for potentially fixing inflation at the cost of many people's jobs. He also said that the Fed will not be a climate policy maker, a clear hint to his desire to stay out of climate politics. Personally, I think this is a big mistake. I've always been a believer myself that the Fed should be on the front lines of this climate crisis. If you raise rates enough, even the earth is going to be like, damn it, I can't afford hurricanes anymore. Now let's go ahead and talk about the major squeeze stocks that I'm seeing right now. So if you are unfamiliar, a squeeze stock is a stock that is being shorted to the ground, has low available shares left to buy, and then sees enough buyers that causes a massive rush where the price skyrockets, and shorts betting that the stock will go down are sitting on massive losses and can be margin called and forced to further buy back shares to close out of their short positions. The stocks almost always after the squeeze significantly drop, usually towards zero, but the point is the squeeze provides a big rally toe. Now, of course, you need to always remember that trading stocks is risky and you can lose everything, including an arm and a leg, depending on whether or not you got your trading capital from a loan shark. So go in with a plan, do your own due diligence, don't take any wooden nickels, all the usual tips. Let's start with BBY. So BBY has had a rough time. Its sales have been shrinking for years and it's been warning of bankruptcy. Its stock has gone from the $30 to $53 range it held in 2021 to just $127 at recent lows. Short interest is at about 38.58% of free float. It's currently in the process of trying to squeeze shorts after prominent meme trade activist Ryan Cohen tweeted a cryptic message that people are interpreting to mean buy and hold. And there's always two different ways to look at a short squeeze candidate. Either A, the stock has been beat down and shorted justifiably by short sellers and people are taking a contrarian trade to squeeze them out before it inevitably goes to bankruptcy anyways. Or B, the stock has been beat down unjustifiably by short sellers and eventually will squeeze by sheer nature that the company won't go bankrupt. Which is it for BBBY? Well, probably A. The company reported earnings yesterday and their net sales declined 33%, predominantly driven by a comparable sales decline of 32%. Bed Bath & Beyond brands saw a decline of 34%, whereas their Bye Bye Baby brand saw a decline in the low 20s range. Not to mention that a big reason this all happened was because they have approximately 70% lower in-stock items and a drop in customer traffic in stores. A lot of suppliers had halted their shipments to the company because they were worried that they wouldn't be able to meet the increasingly stringent payment terms, and so many of the stores didn't even have many items in stock if people wanted to buy them. So no wonder people weren't going to the stores. And this was heading into the holiday season, which is of course a crucial pivotal season for Bed Bath & Beyond and all retailers, right? So terrible time to mess up. And it's going to be another 8 months before you have another holiday season. And overall, they reported an operating loss of $225 million. The problem with that is that they only have about $153 million of cash left on their balance sheet. And while they said they're going to be closing stores in addition to all the stores they closed last year, well, it's reasonable to assume that their days are numbered with this kind of cash burn and this amount of cash left on the balance sheet. They are going to go through that real fast. So my thoughts on the stock, well, this falls into the category of a ticking time bomb. It'll squeeze as long as there's interest in it, and interest is on the uptrend for now, but once the dust settles, it'll likely go bankrupt and go down closer to zero. That said, there are usually pretty big opportunities with these as they run. For example, we briefed on this one at about 30 minutes prior to market open on Monday at about 155-ish a share, and it ran to 346 this morning at highs. That's about a 123% run briefing price to highs, which was fantastic. probably going to have a few more rounds and then boom, it's going to die. So if you are looking to play this, make sure that you're watching in the coming days for opportunities, probably after a sizable drop that then shows some signs of recovering and then actually bounces. Squeeze plays can be thought of like a hot rock. They are fun until they burn you, so you can't play the hold and hope game. You have to play the, oh, I'm going to play the game, I'm going to hold the rock, and then I'm going to toss it to somebody else, and if they want to get burnt, they can get burnt. Next, party. So our party play was, well, quite the party. We briefed on it at roughly 22 cents a share Monday morning, and it had a fake out run to 30, and then it dumped, and then in the previous extended hours, it ran to 73 cents, which is a total run of about 231% briefing price to highs. Now, obviously, not all of our ideas run like this, and these are some of the best, but the point is that squeeze plays specifically can be great opportunities, whether or not the shorts are justified. But why did it see this massive rally? Well, similar to BBY, the stock has been beat down to the ground on fairly justified bankruptcy fears, and with the company making some efforts to try to ward off bankruptcy and people buying in hoping to squeeze shorts out before that happens, it creates this contrarian trade environment. For example, Party City is known for selling balloons and other festive supplies, but apparently they have had a hard time even doing that because, well, the balloons are struggling with the helium shortage. I mean, it's almost comical that Party City can't even get helium for their balloons. Even with the helium, Party City was getting destroyed by big actual companies that make sense, like Amazon and other e-commerce players that have most of their business online instead of expensive retail stores. So with the helium shortage and a lot of other problems, it's not surprising that their stock price has been deflating. Ha ha ha. But seriously, I say this all because you don't want to be caught hold and hoping. You want to play the contrarian trades, but not fall for them, right? A lot of people will tell you on social media, Reddit, Twitter, whatever, that these companies deserve every single dollar you have and you should just buy and hold it indefinitely because short sellers are just unjustifiably beating these down because they are haters. No, folks, these stocks, they deserve to be shorted to the ground. The only reason that they are fun as trades is because they are shorted to the ground and can provide some short-term inefficiencies where the people that are buying it create a massive, massive contrarian squeeze. But almost always shortly after that, they die off. So do not fall for the Kool-Aid. Do not drink that juicy, juicy Kool-Aid. And as I make this video, Party is in a big take profit cycle, and we'll see if there are more residual runs in the coming days. Keep it on your radar, folks. And by the way, we publicly showed our BBY and Party and other plays on the channel at the end of the last video. So even if you don't join our team in ZipTrader U, if you pay attention, we do give a lot of the trade ideas here on the channel for free. They don't call me the stock market Mother Teresa for nothing, right? But if you would like access to our daily morning briefings, our step-by-step lessons, private chat, and full price target list, I will put the link to that down in the description below. Coupon code HELLO2023 will get you a sizable discount on that before checkout. Have a great rest of your day, folks, and we will see you in the next one. Make sure to ravish all of the buttons.